Another exclusive interview to ET. Veteran banker KV Kamath believes that inflation in India is well managed, and even as global recovery hasn't happened as per expectations, he isn't worried about India's financial system at all. In an exclusive chat with my colleague Ajay Sharma, Kamath also emphasized on the need to replace EBITDA as a metric to analyze financial strength and replace it by free cash flows.
Again, there is a whole lot of things that has happened over the last 1 year. Whether they can come out of it is uncertain. So, commentary as of today is uncertain. So, I would think the shining star in a sizable measure is only our country. And if we can keep particularly the exchange rate under check, I think we have a runway which is absolutely, I don't see any challenges going forward. Growth per se, I don't see a challenge. So, where is growth impaired? Let us look at that, which I think is at the base of all, should be at the base of all dialogue. First is, do you have demand for product? I would think that Amrit Kaal, 25 years, we have more than enough demand for infrastructure itself, which can transform this country and provide that growth momentum, employment, consumption, et al. Cities are to be rebuilt, roads are to be built, ports are to be built. You can go endless. Then manufacturing to support aspirations, because if underlying growth happens, then aspirations rise, which we are seeing today, and we have been seeing for the last 2 years. Third is, of course, agriculture, I think, is running steady. We are still dependent on monsoon, so there will be ups and downs, but running steady. But other piece which I don't see any economist having really applied his mind is digital India. The transformation that digital India is having on people's lives in villages. I am not talking of urban. Urban, it is visible to you and me. But what is happening to people in urban India, rural India, given device affordability, given data affordability, virtually they are using it as an extension of themselves in rural India, as in urban India. And this provides digital India a tremendous opportunity to grow. But almost everything that we are doing has to be reimagined, including financial services. But I think that that is happening at a very rapid pace. And so we won't lack for growth. So if I were to break down growth in the future, I don't know every component, digital India should move, in my view, in the next 5 years from 5% to say 20% of the GDP. And I don't think we have factored that in as yet. So if you are saying our growth is going to be 6 to 7%, I would say please add 20 to 25% to that, which will come from digital India.
Which we are underestimating.
Which are as of now not understanding the power of this. But we are seeing it happen, but we are not able to capture what impact this will have on the people at the bottom of the pyramid and coming up the pyramid.
Right. Okay, I'll come to that. I understand that you are working on a project in that side on how to really take the help of digital India and financial services disruption and put it together into something which may not have happened so far. But I want to talk to you a little bit about banking sector. I remember one of our ET Now programs from three years back. You had said that I've never seen the bank's balance sheet so strong and healthy in my entire career. And they have almost 50% rise in Bank Nifty after that. The market realized that how great the banks were. Now the sense is coming that the peak of profitability of the Indian banking sector may have been hit already, and margins will come under pressure, all of that. Credit growth is around 18%. What are your thoughts on growth and the outlook on the sector?
Banks will continue to be I would say, provide the bulk of the support for growth. There is no question about that. But 3 changes will happen in the banking system. One is digital. So almost everything will have to move to digital. A lot of banks, so most of them are moving at very rapid pace. We'll have to see the interface of the neobanks, the digital banking system on this. We will have to see it as we go along. But more importantly, banks will need to realize the second point, that the period when they had low cost funds, they could lend at high rates, margins and NIMs looking good, are over.
Okay.
So where will gains come from? Well, whatever you have in terms of deposit growth will provide you your feedstock, as it were. My own assumption is deposit growth will be actually sharply moderated. It is already moderating because insurance and asset management is growing at twice the rate.
Sure.
So it is already moderating. So you will have to look at how you moderate lending. Margins, NIMs will come under pressure. because your lending rate will have now a ceiling in terms of how much you could do, whereas your borrowing costs are going up. So where do you get efficiency? By moving digital. So banks per se will have to move to a digital environment to cut your operating expenses and the cost to income ratio to maintain your profitability. However, the good news is the credit quality continues to be good. The cleanup of the last 5 years, I think, will hold. And credit cycles, I do not think will morph that easily because there is a lesson that is learned, including at Retail India. There is talk that Retail India will perform. I think Retail India will perform because there are so many metrics now going into analytics that it's not a problem.
Sir, I also wanted to ask you about the banking credit growth, 18%. Do you expect it to hover around or taper it down a little bit?
No, I think it is, my assessment, it's lower than that just now. And that credit growth will not be in those numbers.
Okay, sure.
My number was it is low teens.
Low teens. Sir, let's talk about the financial services sector now. In terms of financial products, we have seen number of demat accounts going a record through the roof in our country. We saw SIPs going almost record high every month. It appears that people are, for a variety of factors, are really moving towards financial assets. What are the trends you are observing there?
See, yes, indeed there is a move towards financial assets. There is no question about it. As I said, it moved from land and gold to banks, and now it's going into hard financial assets. The reason that is driving it is to be understood, and it's very clear to me. Again, there are 2 or 3 underlying things which are pushing this. The first is, I think the saver is looking for higher yield. The banks were not providing that yield, so he's moving away. And the banks are in a catch-22 situation. They have a challenge. Whereas other products are providing higher yield, whether it is debt instruments or equity instruments. The reason why we see the number increase, and I think it will continue to increase, is the ease of dealing with these products today. Compared to 5 years back, when you had to physically deal with an instrument, today you are digitally dealing with the instrument. And the entry of new players into this space who are completely digital, as opposed to banks which are still physical and digital, largely they are also moving, but here it is visible. It is basically a digital move. I think is what you're seeing in terms of growth in opening of accounts, and B, the SIP growth as we see. And I think it will continue. It will only accelerate.
So we have, say, around 11.5 crore demat accounts and say around 4 crore individual folio numbers. In the next 5-7 years, you see huge growth there?
I would look at this sector growing at 20%. So in 5 years, you say it will be 1.5 times, 2.5 times where it is. So it will double in 4 years. It will double.
Okay.
And the 5th year, it should then give another 25% growth.
But the way overall Indian banking system is underwriting risk right now, conducting the exercise of lending and the frailty of banking system, which was say 1.5 decade back, that doesn't exist anymore.
I can endorse it. It doesn't exist. You see, and I'll give a thing to it. The structure of lending 10-15 years back was on a particular basis. If I go back 20 years back, was on the basis of an India where there was nothing and we had to build. So we said debt equity ratio will be 1:2, 2:1, 2 debt and 1 equity. And every project would have that, because that's how India grew from 1950 to almost 2000. Then it became in terms of, it's not a sacrosanct ratio, it can be a higher ratio or a tighter ratio depending on cash flow. So it changed. And I think there have been a lot of learnings in the last 10 years. What is the primary learning? If I look at post-opening and post 15 years last year, that there are risks which are, not measurable a priori. So you need to make sure those risks are what we call implementation risks. It could be land acquisition, it could be mining rights, it could be spectrum rights, it could be a variety of these things, access through an area which is environmentally fragile. All this we did not know in the past. And when suddenly these were brought to the fore, as the project was being implemented, a lot of projects got hurt. I am looking at real reason why a number of projects have failed. Now, all those learnings are with us, and I cannot see any banker now making that mistake again.
Once again,
they are documenting each and every risk very clearly and making sure that those are addressed before you go ahead. So I'm not worried about the Indian system at all.
So one last question, because we are meeting on the occasion of the Investment Advisors Forum. What kind of innovation do you see happening, or disruption do you see happening in the world of financial markets for retail, HNI, all that kind of market? Just got very excited about markets.
See, again, you touched upon it. The saver is now going into products which earlier on he or she was not going into. And as the ability to save increases, the need for advice also increases.
Yes.
And I think ARIA provides a service which is much needed. And in the West, this is the route to creating wealth. So this saver today, you quoted the growth in demat accounts and the growth in SIPs and dealing, as it were, and not necessarily day traders. I'm not talking of that segment. I would think anybody who is not a day trader needs the service of, and I'm sure some an institution of players like members of ARIA. And I think that number has to grow tremendously, because that number otherwise is a very small number to serve this vast population and the vast number of opening of accounts. So I think not only is the outlook good, I think there are more players needed in the system to handhold the lay investor.